So, hello and welcome to this week's instalment of Nucleus Investment Insights. And today our show is entitled The Four Horsemen of the Apocalypse. I won't go into it any further. I think we'll just we'll leave it to your imagination. I will fill in those blanks very shortly. So, I'll just start before we jump into the agenda by welcoming back our chief strategist and very own horseman, David Llewellyn Smith. Hello, David.
Hi, Tim. That tone of voice is far too cheerful for this potty.
True. I've got to try and brighten it somehow. And we've also got our head of investments, Damien Klassen, with us today. G'day, Damien.
Hi, Tim.
Fantastic. Okay, so let's roll into the agenda. And so the four horsemen of the apocalypse in today's scenario is namely, number one, Brexit. We'll then be looking at number two, the trade war. Following up with number three, Hong Kong, and finishing off with a perennial topic, I guess, in number four, in oil as well. They'll then be finishing on the apocalypse being the global recession, not giving too much away, I hope, there. And then, of course, rounding out with an investment outlook and how we incorporate these themes every day in the MB Fund and Nucleus Wealth portfolios. So with no further ado, let's jump into it. Horseman number one, we're kicking off with Brexit. Who'd like to begin?
You want to have a crack at that one, Dave?
Yeah, sure. So look, we've subtitled that letting inertia do the dirty work, and our take is that we've seen over the last couple of days we've had Boris Johnson come out and prorogue the Parliament, so basically trying to cut down the number of days in which they had, and there's lots of machinations going on all sides trying to work out how they can either delay it or speed it up or whatever your current preference is. But our take is that we've got this deadline of 31st of October, which is basically if nothing's been agreed upon, then there's a hard Brexit as of that date. And our view is that Boris and his cohorts are basically going to try and limit what can be done with the view that put some appearances as to what they're trying to work towards this. We're trying to help, and we really want to get a good result with the effect of, we hit 31st, it wasn't done, we did everything we could, and here we go, hard Brexit, guys, strap in, is sort of our take. David, I don't know if you've got any different takes on that?
No, I agree with that completely. I mean, I think the fundamental driver is simply the Tory party's being eaten by Nigel Farage, so they really need to find a way of looking like they'll get Brexit done in some guiltless way.
Yeah, and that sort of means that they've got to avoid at all cost an election, because otherwise they'll get decimated. An election without Brexit being resolved in one way or the other, they'll get decimated.
Yep.
And so there's the Labor Party's trying to negotiate with people from both sides to try and work out a more reasonable than a hard Brexit. But their take is, at the moment, is that he'll run a caretaker government until such time as elections can come, and so that's going to be that sort of gets rid of anyone flipping sides, I guess, or you'd think that gets rid of most people who would think about flipping side, unless they were particularly keen on remaining and very public minded, I guess. If you're only mildly public-minded, then you'd probably stick with your party.
Yep.
So the options from here, hard Brexit looks quite likely. A negotiated Brexit, I mean, there is a chance that you'll see something, maybe the EU give a little bit away to because I think they probably see the writing on the wall as well, and come up with a gentler Brexit, because I think a hard Brexit has issues for the EU as well as Europe, as well as the UK. It's not a one-way street.
And by that, do you mean looking then at a Fraxit and a Grexit and a
No, I just mean
a tipping point, or?
Well, I mean that's further down the track. Italy is the next issue. I think the biggest issue is in terms of is that there's going to be disruption to businesses. And disruption to businesses doesn't just mean that UK businesses get disrupted. It's the European ones that had supply chains and all these other offices in London and all there's a multitude of issues that need to be done. I think there is a silver lining in that I think most companies have had enough time now to certainly consider what was happening. Mm-hmm. I think there was if the day after the referendum, you had a Brexit, it would have been chaos.
Yep.
So I think there will be considerably less chaos because as a companies you should have been looking at it, and I believe most major companies anyway have sort of gone through the processes of what would it look like, what would it mean for us, and so so I guess it won't be as bad as a surprise, but there will certainly be short-term negatives for the economy. We think longer term, especially if the pound gets hit particularly hard, that it is a positive. And maybe you want to talk, David, a little bit about the effects of a hard Brexit?
Yeah, well, I mean, there is a little bit of Y2K about it for the reasons you've described, but the impacts will probably still be materially negative.
And what David means by Y2K is our analogy there is the Y2K bug was back in 2000, and there was this huge process leading up to it where everyone had to make their computers ready for Y2K bug. Otherwise, planes would be falling out of the sky and toasters would stop working and all these other sort of factors that people had coming into that. A lot of that was scare, but there was a significant amount of truth to it, and the fact that it turned into such a big scare campaign meant that the problems that might have slipped by without a big scare campaign were largely resolved.
Yep.
And so, so we think Brexit is to a certain extent similar. I mean, we do think though there is going to be some short-term negative, regardless of whether
there is, and the problem is that it's landing on a European economy that's already basically in recession. At least the core is.
Yep.
Germany is in recession, and a lot of other countries within the EU are following it down. So the last thing they need right now is a little external shock to shake business up even more. So it's going to make this European recession worse. So that's a very large component of the global economy that is going to sink in 2020, even further than it has already. I mean, how far it goes down in terms of hard Brexit itself, I mean, you'd really need to see some contagion of some sort into financial markets. Difficult to know whether that's going to happen. You would expect most people to have neutralised any real leverage or trade to a hard Brexit, but you just never know when these things happen, and somebody might be, long the wrong bond or carrying too much junk in some way or whatever it is, and trigger some kind of debt event. But that seems, should have been neutralised. So the main impacts are likely to be just a hit to productivity, a further slowing in the European economy, and that's going to weigh at the margin on the global economy.
Okay. Yeah, in terms of a broader EU breakup, I think the effect, how bad things get in the UK is probably going to correlate pretty directly. And so if you get a short, relatively sharp recession, the currency takes most of the pain, and then you actually see the UK economy start to expand off a lower base. People will pretty quickly forget the short, sharp bit, and especially in Europe especially in places like Italy, where there is a significant amount of people who are looking for something to change. You could easily see that then be the trigger for the next country and the next country.
And the longer term implications for Europe are negative on a successful Brexit.
Right. Yep.
Or even just a Brexit that's short term. As long as it's short term, as long as the bad part is short term and the successful part is the longer term.
And that's a big bit, isn't it? That the EU needs to make sure that this looks like a bad example, a bad thing to do, because otherwise they might have a run on their hands.
Yeah.
That's right.
Okay.
Yeah, and Italy's the obvious candidate with its anti-Euro parties that are controlling the government now. They're sort of all jostling for power, and it's collapsed and is reforming in a different shape, but they're still all Eurosceptic.
Yep.
And so it's been, had its growth constrained for a very long time by, fiscal rules coming out of Brussels. It's got a lot of external debt as a result, and so, Italy with its own currency, that's much lower than the euro, would be growing a lot more strongly.
Yep. Yeah, very good.
Yeah, Horseman 2.
Okay, Horseman 2. So we'll jump across now to the trade war. And we've got a terrific chart up here on the percent of US imports from China. And for those that are listening in, of course, there will be the chart pack available in a link in the show notes. Just a reminder there. Who'd like to kick off?
Yeah, so basically the chart's showing, we started back in the 80s and 90s at sort of about 30 to 40% of Chinese imports had some sort of trade protection on it. That fell to about 8% in 2017, where we hit 50% about a year ago, and that's about to jump again. So but it's been relatively steady for the last year, and that's about to jump again September 1, and then there's another batch coming through before Christmas.
Which pretty much brings it up to all imports from China.
Yeah, that's right. And then you start talking about how much, and I think every time Trump jumps on his Twitter account, the amounts increase or decrease or get delayed, but it's certainly a lot, and it's not doesn't seem to be getting. The intensity is increasing.
Yep.
In terms of what's happening. And so that's worth. What we thought is we'd just jump back to goals and just comparing what China's trying to get out of this versus what's the US is trying to get out of it. I might flick back to David to discuss some of those.
Sure. So, I mean, the key driver is. Basically, we see this as a kind of hegemonic struggle as much as it is a trade war. So, key goal for the US is preserving its tech leadership. This is where you get to the issues of IP theft and unfair trade rules requiring, the passing of intellectual property to local Chinese, etc., for access to their market. And obviously China, on the flip side of that, is trying to gain tech leadership. Now, there's a key reason for China looking to do that, and that is that its present growth model is running out of petrol. Its development model to this point has been very investment-led and involves, a lot of sort of misallocated capital into building. And that's kind of running out of rope for them. And the way out of that, if you persist with that for too long, what happens is your productivity dies and your income growth starts to sort of diminish. You end up in what is called the middle income trap. The way out of that is to move up the value chain. So you start to value add to all of your manufacturing sectors and service sectors. You do that in part through tech leadership. So for China, this is actually about transitioning to a higher value add, higher income, consumer-led model of growth, and that would, in theory, takes it beyond the middle income trap, and then at that point it's, developing sort of rich, developed economy status, and that gives you obviously more power as well, a higher powered economy. So, the flip side of that for the US, of course, is capping Chinese move up this value chain, both to preserve its own leadership in economic terms, but also, again, in strategic terms and hegemonic power. So it's a bigger story than just trade. Excuse me. So
as you can see on those ones, I guess what we're trying to compare and contrast here is US wants one thing, China wants something that's pretty much diametrically opposite. There's not a lot of room for negotiation on that front. Yeah,
that's right. So then we've got this question over how these various goals are being approached tactically. The US is sort of renegotiating various alliances. It's got a very unilateral approach at the moment under Trump, which some argue is actually a problem for its objectives, because you could be more successful if you lined up other economies with your goals, and that's an opportunity for China to build an alliance network against that. By and large, the US alliance network has been holding up, even if it's been undermined, and China has failed pretty much to wedge anybody other than people or economies and countries that are kind of already its satellites. You could argue Australia is one of those. I was
going to say Iran, but
certainly Iran, but possibly Australia.
And part of that is, so China went with its One Belt, One Road initiative, which was sort of trying to roll out a lot of infrastructure and using that as a bit of cover for, we're going to spend all this money in these countries, and that will help, grow our links together and also, I guess, expand China's sphere of influence. But and while that sounded very good at the initial stages to a lot of countries, I think there's been a number of countries now that have shown up where throwing lots of money at infrastructure products in developing countries rarely works out that well, and they're running into debt problems, and China's calling in on the debt and taking over some of the strategic ports and
surprise,
key infrastructure, and so that's obviously making an issue for more people saying, this money which seemed great does actually come with strings attached, and now we're actually seeing what some of the strings are.
Yep. So just those last couple of points again, it's about a hegemonic struggle, democracy versus communist power, uniting, internal polities versus external threats for political gain.
And so that's important, I think, for both countries insofar as having an external threat for Trump is quite positive in terms of voting.
It's akin to a war almost, really, isn't it? In a way. Yeah.
You want, if you can unite your population behind, here is a common enemy, and I get to stand up and be a strong leader and shake my Twitter account at people and tell them what I'm going to do. That tends to be a vote winner, whether Trump manages to keep the vote.
I think that holds even if the US economy starts to slide badly.
Yes.
I think that sentiment, in fact, might even intensify as you feel pain.
You've got someone to blame?
Yeah, you need someone to blame. I mean, I'd use the analogy of George W. Bush when he ran for his second term and the wars in the Middle East were going quite poorly. But, when you get into those moments of nationalist spirit, changing horses halfway through a strategy doesn't actually make a whole lot of sense unless the horse is literally dying before your eyes.
Yep.
And so, that's not a difficult political play.
Yeah, sure.
I guess is the point.
Yeah. And China has the same issue in that Xi has appointed himself emperor for life, and that with it comes the issues that when things start going wrong, then if you're the guy who has all the power, then you start getting the blame. And so he's seeing that effect come through now. He sort of consolidated his power network, and the Chinese economy is slowing, and he's sitting, and more so because of the trade war, but there's other factors going on as well. And so for him to have an external enemy to unite the citizens against is very important, because he knows his economy is going to keep slowing. And so if he can...
And that goes to the sort of deal with the devil that the Communist Party did, with its people in terms of, shoring up its own power, limiting their freedoms, but in return offering... prosperity.
And that's an interesting point, because I guess essentially with the US putting these tariffs on, all they're doing is decreasing demand, which is then slowing down China's ability to keep everybody busy in a way, and so the common enemy is, okay, we'll blame the US because they're not buying our stuff. It probably doesn't going to hold a whole lot of, versus say like a strategic or a military sort of standpoint.
I still think it'll work.
You think it'll work? Yeah.
I think so too.
Yeah.
I mean, the Chinese mainland is very nationalistic.
It won't be worded the way you say it.
No, it won't.
Yeah.
No. They've had many years of like serious propaganda shoved down their throats. So.
And little access to external sources to verify it.
Yep, fair point.
And dissenting views. So I think, so in terms of that, so as you're looking through each of those, you're sort of saying the tech leadership moving up the value chain, they're sort of at opposite ends. I think the US is probably happy to let China do a little bit on that front as long as they're playing fair and not stealing stuff. But the experience to date has been any time you give them an inch, they'll take a foot type thing in terms of, and so I think there's a lot of skepticism on that front. The alliance network, they're obviously both trying to build it, and the that part about it, there is a domestic reason to keep something bubbling away in the background is I think core to both, which is why we think there's not a fast solution coming to this.
Yep, sure thing. Okay, so how does it all play out?
So, well, I mean, we're already into tit for tat tariffs, and the ball's now back in the Chinese court, having raised its own tariffs on the US goods, and then immediately had further tariffs from Trump within literally minutes or hours. So I guess we await, a further escalation from China. Huawei, there's a whole bunch of pending stuff around how the US is going to handle that. That's tied up with, the broader trade discussions. China wants Huawei, kind of off the banned list before they'll talk. The US has no interest in doing that at all.
Mm-hmm. And I guess that's probably a short part for, I guess, what we mean by Huawei is actually a little bit of a microcosm of the rest of the economy, where the US are putting the clamps on Chinese companies that are trying to expand externally to say, well, if you haven't been playing by the rules, we're going to clamp down on you.
It's a great example, isn't it, to make? Yeah.
So there are plenty of other examples out there, but there's in Australia, we've got ones now, a mining company next to a missile range, and discussions about what they've been doing and have they been playing by the rules. And if they haven't been playing by the rules, maybe they need to change. And you can just go, right around the world. You can go through those, and there's more than just one example.
Okay,
yep.
Sure. Global supply chain,
and this is the big one, really, where we're seeing day by day companies declare they're pulling their supply chains out of China, manufacturing and moving them largely to Southeast Asia. Some of it probably goes home to the US, but not a lot. Apple, we had Google declare last night it's moving some production, but this will take time. It'll take years, probably a decade. I mean, there was a story yesterday in the Wall Street Journal about the mad dash for Vietnam. But it's so heated with everyone trying to redeploy their production to Vietnam out of China that they've got a major kind of inflationary boom going on the ground, and it's very difficult to get in there because it's a narrow entrance with a lot of people trying to get in.
And it's not that big of a country.
It's not that big of a country, and it's actually not a US ally particularly either, so I'm not sure the risk managers have got that one right, to be honest. But, I think you can expect that this push of manufacturing supply chains out of China to continue no matter the result of current negotiations.
Yep.
I think the horse has bolted on that for various reasons.
Yeah. Well, and it sort of exposed a commercial point that, by concentrating all of your supply chain in one country, regardless of the country, if issues arise at a political level, then you cook your business model in a way, don't you, until you can figure it out.
Yeah, and I do think that China's pitch to the world of being, capitalism with Chinese characteristics has unravelled on this. It is a totalitarian regime.
Yep.
And when it comes under pressure, its responses tend to be authoritarian. And so, the freedom of movement that you need in a liberal economy can disappear overnight.
Yep.
At the whim of, the Politburo or indeed the Emperor.
And some of the highlighted by places like where the US asked Canada to arrest a Huawei executive, and in response, China arrested a number of Canadian business people and diplomats.
Yeah.
And so, if you're a Canadian company in particular, and you're just about to pop over to China to tour some provinces to look at setting up your new factories, you might just have a second think about it and go, well, maybe from the company perspective, it might still make sense, but from a personal perspective, it doesn't. And I don't want to send any more of my staff over either. So
that's right. The FT was discussing the deployment of a corporate social credit score yesterday as well in China. Now, in some ways you could see that's not a bad idea. But certainly it's a better idea than doing it for individuals. But it is very much an expansion of this autocratic power around what is, mooted as a liberal market when it's not. And they're saying, look, this is just a corporate credit score, if you like, to keep you in line with regulation. But it's very easy to see it being used or misused for, forcing companies to toe the line on whatever it might be. It could be Hong Kong, or it could be the arrest of one of your executives. It could be
getting licenses to do whatever.
It could be anything. It'd be very easy to misuse. So that it looks like China's jumped the shark. On this.
Okay. Boycotting of US goods.
Yeah, well, this is a nasty one. This is another escalation that's probably already underway, but it's obvious that you could create a moral panic in China about US power interference, holding China back, you name it, and get boycotts underway on US goods or any kind of foreign goods that are being sold in China.
The main sort of imports of or exports of the US into China are primary production. Am I right? Soy, and sort of some
and advanced technology.
And IP. Yeah. Okay, fair enough.
Yeah, but I mean, obviously, it's a big market for stuff that's made in country. They sell. Well, they used to sell a lot of iPhones in China. They're falling away pretty quickly, and whereas
luxury goods.
Yeah, luxury goods. I mean, lots of stuff that is Western IP but manufactured in China.
Yep.
It has Western brands. And so rare earths, we think this one's a bit over-egged, but it's obviously China's monopoly on rare earth commodities. Its competitive advantage is
commodity production, not the commodities themselves. Production.
Yes. And so, I mean, various components of the Western alliances are sort of working on getting around this already. There's a story yesterday about the Pentagon doing a deal or trying to do a deal with some Australian miners to get rare earths underway here. But I just don't think that this will be a huge deal. It's just a case of building out the production elsewhere.
It could be a short term.
Yeah.
It could be a short term issue. But having said that, it's a card I think that China would be very foolish to play, because all of a sudden, if they play that, then the whole supply chain just goes out the door. Like if everyone says, well, if you're prepared to cut off the rest of the world for a political whim, then we don't want to stick any of our supply chain with you.
Yeah. And so I feel like we've glossed over the rare earth sort of topic a little bit. Do you want to just quickly run what a rare earth is?
So rare earths actually aren't very rare. They're actually pretty abundant. What's rare is countries that are willing to host the refining of the rare earths into usable materials because they're so toxic.
Okay.
And China tends to have less stringent
EPA controls,
and that means that it's very attractive to do rare earths in China. It's been very attractive, and so they ended up being the lowest cost provider, because if you're in the US, you have to abide to not poisoning your local citizens. In China, it hasn't been as much of an issue, and so you basically close down rare earth production right around the world. And so and now, because China's got all the rare earths, they're talking about and touring factories with the G to sort of suggest to let people know, hey, we could just turn these off. And these get used in everything, phones, TVs, communication devices, right around the world. So there is very much, they could certainly cause some serious issues in the short term, but that's, to us, seems very much cutting your nose off to spite your face. I think they'll.
It's particularly crazy to take this trade war into commodities for China, because I mean they're far more dependent on commodity imports than any commodity exports. So it's really bonkers for them to give this idea to anyone else. I mean you just don't want to go this way. Like, blockading commodities is a very bad idea for everybody.
Yeah, fair enough. And finally, their China devaluation.
Yeah, this is a big one that's underway again. Obviously, they're devaluing the yuan reasonably swiftly now, and it's going to continue, I guess. So, that puts all sorts of pressure on many different things. It's very deflationary for the world. It obviously is a big competitiveness blow for all sorts of different emerging markets. Although that's going to be offset by either a shift of supply chains out of China. It's extremely negative for the Australian dollar. The two track one another. And obviously it's thumbing its nose directly at Trump's tariffs, and so it's prodding the bear in that sense. So it's another escalation, definitely.
Okay. Very good. And so we'll wrap around now into some risk scenarios. So we've already seen a couple. We can strike a couple off the list.
So we put this up a year or so ago. Just sort of going through. Here's your gradually getting worse. stage. And the first part was a quick resolution, which we sort of gave up on last year. So I think we've always had the view that it is bigger than the headlines, and so the quick resolution would have meant equity markets back off and running. The next sort of positive effect might have been sort of twin Keynesian booms, in that you saw the US with a big infrastructure spend and China with big infrastructure spend trying to sort of keep their own economies going and both of them creating demand for the rest of the world, and that doesn't look like it's happening.
Yep.
So we've crossed that one off the list. Might come back, but we don't think so.
I'll just add, in particular, I think China is very deliberately not stimulating, and I think that's clearly a strategy to hit the US economy and try and upset Trump's re-election.
Okay.
But I think they should just look at how they manage their own polity to figure out how dumb that is, because it goes back to the whole external enemy argument, etc. So crossing that one off is quite a big deal for Australia, because we don't see any imminent Chinese stimulus as a rescue for falling bulk commodities.
Yep, great point.
Yeah, and so now we're in these second two, which is where we think it'll probably sit, is in this escalating tariffs and outright sanctions. We think it'll sit in between those two. But if things get, if things could easily get worse than that, and you could start seeing the proxy wars and the potential of a real war. So our base case was we'd be sitting somewhere in this escalating tariffs and outright sanctions part, and that's where we find ourselves now. So the issue is things could get worse. But we're not expecting that as our base case at the moment.
Yeah, okay. Yep, sure thing. Something to keep an eye on. And I noticed there we've got proxy wars as second last to real wars, and it sort of somewhat maybe draws us into our next topic. So the third horseman being Hong Kong.
Yes, it does. So, I mean, this one's not specifically a proxy war. It's more...
although China is claiming in some circles that it is.
Yes, they are. And in fact, it has become inveigled with the trade war. Increasingly, Trump has made reference to the two being connected, but he's probably just using that as leverage. I don't think that Trump would have any compunction in selling Hong Kong out if he could get a spectacular trade deal. But in terms of this kind of being the third horseman of the apocalypse, as it were, as a possible looming global recession, this is another issue that's been getting worse, not better. This chart that we've put up here seems to capture, what's transpiring on the ground rather well from The Economist. It's basically just a breakdown of ages, demographic blocks, if you like, in Hong Kong, and those who identify themselves as Hong Kongese versus Chinese. And the movement in the larger blocks from, youth through to 50 is clearly towards independence, and in the youth it's skyrocketing. What's interesting perhaps about this chart is that it's not something that's, it's obviously going parabolic at the moment, but it's actually been climbing very strongly really since Xi Jinping came to power, which kind of tells you that the honkies have been looking at this for a long time. They had their 2014 umbrella revolution. Was a sort of dry rehearsal, if you like, for now. But all my contacts in Hong Kong and whatever are basically telling me that this is the do or die moment for Hong Kong, and that's there's all this incredible kind of foment on the internet in Hong Kong around this, which is coordinating the protest. It may be leaderless, but it's not directionless, and it's got this this really kind of fascinating online network, if you like, that's driving it. Not unlike some of the stuff we saw in the Arab Spring and other kind of popular movements.
I was going to say there's a few correlations you could draw to the Arab Spring.
Yeah. And this coordination of communication is why, for instance, over the last few weeks we've seen the protests kind of push towards dangerous violence, which could have alienated kind of middle classes and more conservative peoples. Yep. And then within a week, bang, nearly 2 million people were on the streets, totally peaceful. Yep. Extraordinary shift when when this movement sort of sensed it might be losing the narrative and then snap back to like peaceful protest. It was like extraordinary, and it's leaderless. So anyway,
but, and just for anyone who's listening in and not looking at the charts, or actually even to just draw out in particular, there's what I found fascinating with these ones is not, I mean, certainly the rise is important and everything. So it's risen, say, from 2010 from about 40% to closing in on 80% for 18 to 29s. But what's interesting is you're actually almost at zero for who identify as Chinese for both that category, and the 30 to 39 category is now almost at zero. So you're either identify as Hong Kong or mixed. Nobody... Whereas there was significant parts of the population would identify as Chinese.
Like my sources on the ground are telling me like that it's literally reached the point now where you don't want to speak Mandarin in Hong Kong.
Wow. Yep.
Like if you speak Mandarin and someone will start looking at you on the street and, suspiciously.
Yeah, right.
And this is creating like almost civil war like atmosphere where you imagine a wedding. Right, various generations come together. Some of them only speak Mandarin.
Yep.
And so and then you've got the youth that are like full blown going a different direction. I mean, it's out of the box. It's out. The genie's out of the bottle. And and that
sort of flick to the next chart, because that's the interesting part now, is that the real key to whether this keeps going or not is going to happen in the next 2 weeks, because we're back to, well, maybe not, maybe the next 2 months. University holidays go back. And that's sort of been a bit of a line in the sand. A lot of people have been going, well, it's a summer fling, something to do. These guys are all bored.
Bored kids.
Summer holidays. Once that's over, they're going to go back to uni.
The weather's been good too.
Weather's been good. Yeah, that's right. It'll all die away. And so that's the point, as David was saying, is that's what happened last time, in a way, in the Umbrella Revolution, and they made a few changes, and the whole thing died away. One side says, well, that's what happened last time, that'll happen again. The other part says, well, that's what happened last time, and they know it was a mistake. And they know that if you don't let go, as David said, you don't let go when you've got the narrative and you've got people active about it, then you'll lose your opportunity for 5 years at least, and maybe forever.
I mean, that's it. The narrative I'm hearing is that this is do or die for the honkies, and the legislation that triggered it speaks for itself. I guess the extradition laws, which were basically going to allow the Hong Kong government to deport anyone they liked into the black hole of the Chinese legal system, such as it is. That was just simply they cut the sausage too fat, and they've triggered this huge pushback. And where it goes is is really difficult to know. I mean, that legislation has the Lam government has declared it dead, but it's still sitting on the books. Like, it hasn't been removed. And if the protest stopped, it could be passed overnight. Right? It's still there. And then there's the other 4 demands that most of which are actually pretty reasonable, but then they kind of escalate all the way up to kind of democracy, where that's obviously going to be a non-starter. At this point, there's been little or no movement or budging on the part of the Hong Kong government. Obviously, Beijing is the one pulling the strings there. Are we going to see any? Like, I thought they should have just sacked the government ages ago. My mail on how this would affect the mainland is that basically they hate Hong Kong.
Okay.
There's not a lot of risk of this sparking any kind of revolution in mainland China. They don't really care. They actually just see them as rich assholes who, are taking the piss.
Okay.
Like, we're over here working for the team. What do you think you're doing, kind of thing. And so, therefore, the communist government may have a free hand in terms of, mainland politics for what it does. But what does it do? My God. You can't send the tanks in.
No.
Some kind of martial law. That's 5,000 troops sitting in Hong Kong. Perhaps, but I mean, the moment you do that, that's the death of Hong Kong as a financial centre.
Yep.
Obviously exacerbates everything we've already discussed about supply chains leaving China in the trade war. It's a moment of it. I see that as the the end point of Chinese globalisation.
And that's an interesting point, because we spoke before about the Arab Spring. Is there a chance that this could fuel an Asian Spring, where you've got Hong Kong and then Taiwan and then any other province that sort of borders China that they've stuck their fingers in over the years?
It's clearly booted Taiwan several decades further down the track in terms of one China policy. Whether it leads to an actual spring, who knows? Taiwan is off the radar for China now for another generation. They're very good at planning for the long term and thin slicing their way to victory, and so they go back to doing that. But the prospects of any imminent merging with Taiwan is the major casualty for China's strategic policy coming out of Hong Kong. So that's gone. But they still don't have a resolution for what to do in Hong Kong.
And part of what I've put up there, one of those things that parallels with the trade war, in that we feel as if a quick retreat and give up some short term and get back to thin slicing would have been the right way to do it. But it's a eerie parallel in terms of saying, I think, whether it's hubris and whether it's saying no, this is ours. We're gonna meet force with force, and so that's the part where both of them to us say that things are going to keep going the way it's going.
I mean, maybe the Ministry of State Security can get in there and arrest enough people, undermine it, divide the movement. I mean, who knows? But I mean, it looks, it's comprised. It's not just students. Like it's accountants.
That's right.
It's accountants. There are accountants marching on the streets of Hong Kong. Like it's moved up the value chain.
When you've got 2 million out of 7 million marching, it's pretty broad-based.
It is. So,
absolutely.
So outcomes, I mean, just really don't know. But it does appear that it's a catch-22 that is likely to get worse. It could definitely exacerbate the trade war. I mean, if they were forced to go the route of at least martial law of some sort, for a short period of time, it's definitely going to make the trade war worse. It will certainly align Europe much more closely with the US. It will end Hong Kong as any kind of viable financial centre and leaping point into China for managing businesses, and will just
accelerate the supply chain.
Accelerate the supply chains coming out of China dramatically. It's just all bad. They simply do not want to go that way if it can be avoided, but I guess the honkies know this. And so
got the wedge.
They do, and the timing is impeccable. Maybe they get to a deal, but just does not look to be the way the party thinks, and certainly not the way Xi Jinping thinks.
But it's very tough to negotiate a deal with a leaderless
2 million rabble.
Exactly. Saying, what the demands are, is saying,
the moment you give in, that might just cascade into, we want everything.
So. Interesting. Okay, right. So we'll jump across now to the fourth horseman today, which is oil. And we've got a chart up here of the oil market balance. Do you want to just talk us through this one?
Sure. I mean, I've been worried about oil all year. We're at $55, well down from where we were last year, basically because there's just too much of it, largely because non-OPEC production has been very strong, and that again is focused in the US. And what perturbs me particularly is we're coming into the oil's sort of seasonally weakest part of the year, coming into Q4 and then early Q1. And
why is that typically the down point in the cycle?
I actually don't know. Presumably it's because
winter in the north, summer in the north rather.
Summer
demand.
And
the driving season, as they call it in the US.
Yes, that's right.
Is a large part of it.
Okay.
And so the supply balance is tipping towards glut. It's already fairly glutted, but it's going to get worse as we go into the end of the year. And the reason this is a potential horseman is when oil crashes, then it's the principal line of contagion from the global economy into the US economy these days, because traditionally falling oil was great for the US economy. boosting spending power for consumers, etc. And that's still true in part, but these days it's such a key component of their capital expenditure with shale that's actually a greater downside. And moreover, the shale oil business is run out of the junk bond market, and so you get a dislocation in junk bonds when oil falls, and then that starts to threaten broader spreads, and that upsets the stock market. And at that point, you start to draw in the consumer via the wealth effect. And so we've seen this happen a couple of times through big oil shakeouts, in particular 2015, where it really rocked the global economy. We got through it okay, but the economy is much slower now, and obviously with these various other stresses, if we were to get an oil crash at this point, I think it's a potential trigger for much wider destabilisation. So there has been some better news in the last few weeks. If you want to flip to the next chart, the US rig count has been falling since we dropped down towards the mid-50s.
It's a remarkable fall off, isn't it? I guess
it's not quite as big as it looks, but it's decent.
The axis on the chart.
It's the left chart.
Yeah, that's true.
But you'll see production hasn't fallen. It's actually still very high. That's in part owing to them getting better at it and more efficient. But also the broader US production story is quite strong coming out of the Gulf of Mexico and stuff.
And it's been interesting, actually, just this latest reporting season, there's been a number of big US companies that have been talking about... shale oil is very new, so it's only been the technology around for ages, but the real drive of it's really been the last 10 years, and so productivity has been dramatically increasing over that time frame, just as people get better and more used to it and knowing what they can do. And just in the last reporting season, though, we've seen a number of big companies talking about not quite getting the same increases they're expecting, and about now whether their wells are actually getting too close together, and so it might be a question about whether that productivity gains keep going. It's very much at very early days in that, but to date, that just because the rig count is falling, because the rigs that are coming on now versus 5 years ago are a lot more efficient and they're actually getting a lot more oil out.
So, I guess the point here is that the oil price could stabilise if US production starts to fall off. But of course, the flip side of that is the US is being drawn into this already, where its production is going to start to fall and the oil rig drop and capex fall off, etc. That's obviously a much broader story, oil. As the global economy slows, so does oil demand, and the IEA has been consistently rounding down its forecast for demand. So we've got this potential supply shakeout chasing, falling demand. Not clear which one will win. There's another dimension, which is China is illegally importing heaps of Iranian oil. So, and then there's the trade war dimension to that, where it's displacing US oil, which is then being shoved into the wider global market. And so some of the dimensions that were supporting oil, which was the end of Iranian production, or supposedly pulling that out owing to sanctions, is not happening. And then there is Venezuela and its structural problems, and it's falling away. But as that other chart showed, on balance, it looks like we're still headed into more glut for oil, not less. And so I'm worried that could, by year-end, trigger volatility.
Okay. Yeah, sure. All right, very good. So that's our four horsemen. We'll now zoom into the apocalypse, being global recession. So end on a high note, but anyway. So I've got here a quick equation there: weak economy plus external shock equaling global recession.
So there's two parts I wanted to hit on for this. Is the first part is the economy is weak at the moment, and I've got two charts up just showing global PMI surveys, which is purchasing manufacturing PMI, which is a purchasing manager, and just it's trying to get forward looks at what's going to happen, and both of those are sort of back to close to 10-year lows in terms of where they're back to. So certainly weak. One of them is an output, and the other one's just a global survey. So you've got this weak economy. If you get any of the above ones we've just spoken about, either the Four Horsemen hit, that comes into this weak economy, and that's probably enough to shove it over the edge. The other factor I wanted to raise is on the next chart, which is the amount of corporate debt out there. And just in terms of measuring it versus GDP, because it gives you a better feel for how large it is, because debt tends to grow over time with inflation and income. But we're back at previous high, or back and above previous highs in terms of the debt to GDP. And so what we're saying there is
global GDP, global GDP.
That one is the US one, but it's pretty similar.
You can use it as
wherever you look.
Yeah, sure. Okay.
So, so the issue is you have a vulnerability, you have a weak economy, and you have an external shock. Is that can very easily come together into apocalypse of a recession, and could be a big one if the wrong things happen in terms of the corporate debt markets.
Okay. Sure thing.
So, I mean, obviously the timing of these things is very difficult because we're talking about a lot of geopolitics, geostrategic stuff, all sorts of different things. But I guess what we're saying is if you, as Damo says, sum up the context with, these various potential political, swords of Damocles poised, then it's a very high-risk environment.
Okay, sure.
Yeah. So this same type of effect, as economies are growing and all those same Four Horsemen are speaking about in a growth market where economies are growing, employment's falling, all those other factors, manufacturing is strong, means
it'll get shaken off.
You can ride over one of those.
Yeah.
And so the question is, though, will one of these be enough to shake things out? And there's a decent chance.
To unpick the blouse, as it were. So thanks for that. We'll just before we roll into our investment outlook, we just got a question here, and I'm sorry, Dozbotter, for making you wait on this one, but I just wanted to find the right time to fit it in. I've got here MB, and I guess in the way of Nucleus Wealth are not gold bugs. So your view now, please. So what percentage of a portfolio should be in precious metals? And is it not too late to take a position given the recent run-up in either physical or an exchange-traded fund? Thoughts on gold at this point in the cycle?
I might leave the portfolio question to you, Damo, but I can comment on the gold market and its role in today's environment. It's pretty bullish.
Yep.
And has gotten more so recently. Basically, whenever the Federal Reserve starts to ease, people start to think about gold for a start.
Sure.
Because, that's sort of suggesting imminent US dollar weakness, US dollar being the key component into gold's value. That said, if these shocks transpire, we think that the likelihood is that the US dollar will remain a safe haven play, in which case gold may take a bit of a battering in a crisis if the US dollar does take off. But what's happened recently is, there's now talk of US Treasury intervention into the US dollar coming out of the White House. That obviously is based on, the trade war and the falling yuan. Now that adds a much more sort of spectacular upside for gold, where it could potentially rise even if the US dollar rises, just on the political risk that there may be intervention. Then again, you have to consider that there actually isn't all that much they can do unless they're prepared to go very deep. They can jawbone it, they can do bits and pieces around the edges, but really all they could do is tax capital inflows if they want the US dollar to fall, and that would be a major escalation of the trade war. And if you've gotten that far, then probably the whole world is falling apart, and the US dollar might go up anyway. So, look, it's very much a risk-reward story. That said, yes, in a medium-term story narrative, it's definitely bullish, because you would think that as the global economy slows, as these various shocks transpire, if they do, of course, then the Federal Reserve is forced to keep cutting, and eventually that bites the currency. It usually happens post-crisis, as I say. The currency will often spike in a safe haven manner, but then afterwards, as things settle down, then the US dollar takes a bit of a pounding and then gold flies off. So, I guess that probably amounts to a buy the dip story. for gold in a macro narrative sense.
Okay. And tread cautiously.
Yeah. I mean, I wouldn't be throwing the entire portfolio at it. But I might ask Damo what you think.
Well, I'm not throwing the entire portfolio.
No, you're not.
Gold's not a core asset class for us.
Yep.
Nucleus, the idea behind Nucleus is that we're sitting with the core safe assets, large cap equities, both Australian and international, government bonds and cash, and they're the assets we feel are the safe assets and the ones you pretty much want to own through the cycle, but in varying amounts.
Yep.
And then around that is where you then throw in small cap equities or hedge funds or gold or some corporate bonds or whatever your desired sort of flavour of investment is. And so we tend to look at those as not being a core holding. We do have a chunk of gold now in gold stocks within our portfolios.
I was going to say, sort of like a derivative to gold is obviously the equity piece in a gold miner.
Yeah. But that's we don't treat that as a huge part of our portfolio insofar as we're pretty explicit about what we're buying within our portfolio, and with the idea that if people want to own gold, then they should be owning it outside that Nucleus part, and that's something they'll then trade themselves.
Yep, sure.
So then I'll toss back to David's views on gold. Is that there is some medium term upside to it.
Yep.
Yeah. And you get really good leverage on the gold price with gold miners.
Yeah. Yep.
So,
fair enough.
I mean, I guess the one other factor I didn't mention, I should have, is Mark Carney's stuff at Jackson Hole. It's quite a thing to have leading central bankers discussing the end of US dollar hegemony. I don't think it's imminent anyway. I don't think the US would give it up. Certainly not under a president that's not, entirely rational.
And what he was discussing, just to put that in context, was he was talking about pretty much sort of moving back to sort of a Bancor type model, which was a Keynesian from
global currency sort of.
It was post World War II, I think, just up to whatever it is, 70 years ago, which was basically you get a basket of international securities, and rather than everything priced in US dollars, they get priced in Bancor, which is basically a 50% US dollars and 30% euros and. But it's the key part to that is making sure you've set up all the lines with the central banks that you can actually money can funnel into that, and people can actually get exposure to without having currency controls.
It's actually a terrific idea. Like it works in theory brilliantly. Where once a year they all get together and like rebalance reserves versus various external imbalances, and so it would take an awful lot of volatility out of the global economy, but I mean, that's kind of neither here nor there.
Well,
it's what matters is the geopolitics of it.
Well, if you follow any of Eric Townsend's material, recent stuff, he's got his bets on Facebook's Libra, perhaps being backed as the Bancor of the new world. Yeah.
Well, it's a good joke.
So if you're listening, Eric, there we go. All right, so we'll jump just quickly across to the portfolios, Damien, and what we're doing in reflection of these themes today.
Yep, just very much early days. I mean, we've really only just seen the start of the volatility, and so we're largely positioned for quite negative outcomes, and we're not sort of ready. We're not out rushing out there deploying cash, but we certainly do have our list of stocks, and we're churning a little bit within our portfolios to try and look for opportunities where stocks get beaten down, and whenever you get a chance to pick up quality stocks at reasonable prices. Mm-hmm. So I think the volatility is often that case. Is that what you, especially in the early days of volatility, you often find that there will be hedge funds or traders who are looking for liquid stocks, and they'll be in whatever countries they're in or whatever sectors they're in, and when they've decided that's no longer the case because of whatever they've been stopped out, they'll be looking to get out as quickly as they can.
Okay.
And that often gives you the chance to pick up quality stocks at reasonable prices. So you often see at the start of crises, the stocks that fall fast are often some of the big actual quality names, because it's hedge funds or other asset allocators who are just getting rid of, they only ever owned liquid stocks, and so that's what they're selling.
Yeah, okay.
And then it's not until and then you often see in days following that some of the higher priced less quality stocks they'll then start to fall as the pricing sort of filters through the market. And so if you can use the opportunity in early days of crises to rebalance your portfolio that way, it's often quite helpful for your performance.
Okay, fantastic. All right, thanks very much, gentlemen. And a huge topic today, so we've gone a little bit over time, but I will run into what's coming up next week. So same bat time, same bat channel at 12:30 p.m. on Thursday the 5th. We have got a secret special guest. So feel free to tune in then and check out what we've got in store for you there. Nucleus Wealth Live webinar page as always. And just a quick note as well, for anyone who is interested or has got a topic or something they'd like for us to put up and do some research on and bring to you, please feel free to forward those through to us, the nucleuswealth.com/subscribe if you haven't subscribed as well, just to get that through and we can have a look at that. Also open to any other special guests or anything else you'd like for us to bring forward to you. On that note...
Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.